For now, let's bring in Bankim Chadha, the chief global strategist and head of asset allocation at Deutsche Bank. I don't think the president will come after you for expressing this view, Bankim. Just because, the Fed chair says it's one thing, you're allowed to have your own opinion. But why do you think that we shouldn't have any further movement here? I mean, the inflation reports have been pretty good.
So I think it's a day where, we've heard the arguments on both sides. What I would share is basically a cautionary tale from the early 1970s that is due entirely to my colleague, our rate strategist, Francis Yared. So you will recall in 1973, we had a massive oil shock and shortages. Inflation picked up and the Fed hiked. And what long rates did is actually go sideways to slightly down. Then we got a recession and the Fed cut, which is what everybody is sort of arguing for or clamoring for today. And what happened to the term premium at the long end is went up, and it kept going up. So when the Fed did not cut or actually hiked, the 10-year went down.
Right.
And when they started to cut, it is really like the inflation shock was being accommodated, and the term premium went up.
Which, by the
more
way,
than a percentage
would
point.
you argue that's what, is that what we saw in the fall when they cut and the long end went up?
Exactly. So it sort of all hinges currently on how you think of basically the shocks that we are getting, be they tariffs, oil prices. Yes, we've just done a round trip. But if you think that this is a negative supply shock from the tariffs and the tariffs not resolved, and that's really the next catalyst right around the corner on April the 9th in terms of what happens, if it's a negative supply shock, I don't really think that it makes a lot of sense. Yeah. And it may create a lot of basically relatively perverse dynamics.
You want to know what I would like to do as Fed chair? And this may be unorthodox and frowned upon, but it would be a good, interesting experiment if you come out one week and you kind of, jawbone that you're going to cut, for instance, and you just watch the market reaction. And then you come out, and so is the long end going up or not, right? And then you come out and you say, no, I think we're going to be tighter. And then you watch the reaction.
I mean, conceptually, I agree. It's just that the Fed can't afford to do experiments in the market.
But maybe it'd be safer to do an experiment to kind of at least suss it out instead of just pretending like they know what's best.
My cautionary tale was an experiment. I mean, we already lived through that, right. So it can very easily happen. And so I think initial conditions matter. The fact that we've had this inflation experience over the last few years, the fact that inflation is still above target. Yes, there is going to be a divide. So our economists have a great piece from yesterday, Matt Lazzetti and company, and making the simple point that everybody talks about uncertainty. Well, if you look in the dot plot and the various other things that go along with it, the uncertainty on growth, for example, unemployment, it's actually not very large. It's 30 basis points between the highs and the lows. So there is uncertainty, absolutely clear, but it's not unusual by historical standards.
Yeah.
What is unusual is the divide and relatively bimodal view on what monetary policy should do. So there's the data issue and what's happening in the economy, but the uncertainty about that is not unprecedented relative to history. It's well within the ranges. And the question really is what monetary policy should do. And again, I would go back to, is this a demand shock? Is this a supply shock? The data is not really telling us anything yet, and it's a bit early. So the case for waiting to find out.